Good
Yeah, I
afternoon,
think
everybody. Welcome back to the Opportunistic Trader. We're just after 1 o'clock, and we got a new segment here. We're trying something new. We've got Tom McEntee and Vince Lanci, and we've been speaking with them individually. Vince has his morning segment, the Gold Fix with Vince Lanci, and then I've been speaking with Tom twice a week or so, talking about earnings and options. And both Tom and Vince have over 30 years experience in the market with options, risk reward opportunities, different ways of looking at the market. And so they're going to be speaking together a few times a week, talking about the market, different unique things. It's going to be a great segment. So I'll let you guys take it from there. Tom and Vince.
hey,
Go
good
ahead. Go ahead.
morning.
You
I
take
just
it.
want to I want to add one thing before you take it, Tom. This is going to be a regular, semi-regular thing, and we want this to be interactive. So we're going to be taking questions from guys like Gabe that are asking about P&L type of structures, and questions from Sunil and anyone else who's looking at different structures. It'll be from the basics as well as to the high end, and we're going to kind of wing it today. We have two visual aids. Tom has his he's sharing his screen. That's a volatility smile, or that's the Apple stock going down, right? Or and we have basic P&L graphs in a post that I threw up there. So if there are no questions after Tom introduces himself, we'll just go back and forth and ask each other questions, discussing options. But I promise you, if you listen to this for 6 months, 2 days a week, you'll know more about options than 99% of the earth. And I mean, that's pretty cool, I think. Anyway, Tom.
Well, hey, great. Thank you. Thank you so much, Vince. Thank you again, Michael, as always. So I think let's hopefully this thing should work. It should resonate with a lot of people, and it should be somewhat educational and informative in its nature. That's what we're trying to do. Just take the Greeks out of the Greeks, so to speak.
Exactly.
So you see me put a lot of trades in the chat room, and I'm a lot of 2x1s and calendars, blah 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 blah. And if you don't know it, I'm assuming at a certain level, I'm assuming a certain level of fluency in these things, and I don't know what I don't know how good I am. I don't know how much I understand, to be quite frank with you, but I think it's always good to and I think it's always good to review where we are and where we want to go. And I think to that, and let's start at the ground floor, and we'll just explain what Greeks are and how you can profit. Because options are like anything else, guys. They're a tool, and they're a means for you to attain or achieve investment objectives. And if you use them as a tool, or like a blind man, you don't want to use them like a drunk uses a lamp pump. You want to use them for illumination, not support. So that's what you have to look at in terms of options. And options, when you become adept enough, or adept enough at seeing what option movements and option volatility, or way spreads price, what that might portend, or how you might fashion a trade, be it directional in nature or just a volatility arbitrage kind of deal. There are certain tells out there that if you watch it enough, you'll see it, and you'll be able to profit from. Is it 100%? Of course not. 60% is a home run. So with that, let's start with the very, very basics, and I'll throw out a term, and Vince will answer it. We'll get the ball rolling that way. And if you have any questions, stop us right away. Not a problem. The only like every Catholic, every nun I had going to grade school said, the only stupid question is the one that isn't asked. So please ask away. No problems here. No judgments. You got a question, ask it.
My priest said there are no stupid questions, just stupid people.
Just stupid people. All right. So the first thing is delta. Okay.
Okay.
I'll put this. I'll put this here. I'm going to replace the Apple skew screen with. And let me make this white here. These are Apple options. We don't need this many strikes. Let's go down to about 10 strikes. Okay. Apple's trading at 170. You see the last price of the stock, 173. Everyone can see that's where my mouse is tricking. Okay. So if I were to go out and buy 1,000 shares of Apple for an option guy, I'd be long 1,000 deltas. And what a delta is equivalent stock position, ESP. It's like a 6 cents almost. To just
Right.
So it's it's an equivalent stock position. Now I can also fashion 1,000 deltas utilizing options very, very simply. Now, if I want to do calls, I'm sure everybody knows this, but I'm going to do it anyway. Gives the holder, the owner, the right to buy or sell a stock at a given price at a given point in the future. So, stocks trading at 73 here, for argument's sake, 173 as we can see here. If I were to say these are options that expire on Friday, November 30th, as you can see. Now, these 172.5 calls are roughly 40 cents in the money. Okay, the delta on those, as you see here, is 0.545, 54.5. Let's keep it at 54 deltas for simplicity's sake. Okay, so that means for every one, you're going to options are in multiples of 100. So every one call option I buy would be like buying 100 shares of stock multiplied by the delta. The delta being, say, 54. So it would be 54 deltas. So if I bought one call, I'd be long 54 deltas. If I bought two calls, I'd be long 108 deltas. Okay? That'd be the same thing. Two of these calls would be the same equivalent stock position, being long 100 shares at 173. Now, the caveat is this. Okay, we'll just keep it, before I go into that, let's keep it with that. Now, the converse is this. Puts on the other side. You know what they say? Vince will know where I'm going with this. Pros, amateur, public trades calls, pros trade puts. And I'll know exactly what I'm saying.
That's right. That's right.
So
when I'm bullish, I buy puts, but we won't.
If I'm bullish, I'm always buying puts. Right, absolutely. So, okay. So now, because of put-call parity, meaning that if you look here, stock trading 73 even, we'll say for argument's sake. With 3 days to go, we'll say interest rates are essentially, they're a wash in terms of short stock here. The midpoint of these calls is roughly $2.78. The midpoint of these puts is like $2.24. So that'd be 54 cents over, puts the stock at all the stocks moving around. The price of this call, the 72.5 call, minus the price of this put, when you add that to the strike price, okay, should equal the stock price. Okay, so you're assuming about 2 or 3 cents in interest here. So this here would roughly be 280, 222 is 58. We give you 308. It's about 5 cents in interest. The thing's moving. It's not. It's not static. So that is called so if I bought one call, sold one put, see the delta in the put. Conversely, with a 54 delta call, the put is negative 46 deltas. It's funny how that works. So that creates. If I bought one call and sold one put. If I sell one put, sell one negative 46 delta thing, negative times a negative is a positive. Means I pick up 46 deltas here. So one call, buy one call, sell one put is equivalent to 100 shares of stock. It's the same thing as going out and buying 100 shares of stock. Same thing.
You synthetically create a stock position by buying a call and selling the put, and it adds up to 100 deltas, which is a share of stock or 100 shares of stock, depending on how it's calculated.
Right. Now, does everybody get that? That's before we go any further. This is. I mean, I made a
you're
living.
You're so ahead of everybody already, dude. You're so ahead.
No, I made a living. Larry remembers me. I made a living trading these things.
No, but you're just okay. All right. Let me just stop you on the delta thing. All right, just for 1 second, because it's the most important thing to talk about. But I just want to start with a very broad. 3 options are used for 3 reasons, and tell me if I'm wrong. If there's 4, if there's 5, let me know. The first reason you would use an option is to express a directional opinion on the market. I think it's going up. I think it's going down. The second reason you would use an option is to hedge a directional opinion on the market. I think it's going up, but I'm worried it might go down. I think it's going down, but I'm worried it might go up. The third reason you would trade an option, these are the very simple ways, is because you think the market's going to move. So the first 2 reasons are directionally based. And those are the basics of why options were created. And those options are used to express directional opinions with different risk, the ability to tailor your risk towards your tolerances based on directional opinions, and et cetera, et cetera. Those are the first 2 ways. The third way, so the first way is trading an option to make money, right? So you're expressing an opinion. The second way is trading an option to hedge a position. So it's insurance. It prevents losses. So that's to save money. The third way is trading an option directionally agnostically. You don't care which way the market goes. You just want it to either go or not go, depending on if you're long or short options. Those are the three ways that options are used. The first two ways are what everyone should learn before they get into things like volatility, arbitrage, but we're going to be touching on that all the time. And I want to say this because talking with Tom is like being back at my first firm. A lot of learning when you're working with traders is not textbook. You know, give me this, give me that, give me this. It's follow the trader around, pay attention to what he's saying, and then tug him by the shirt and say, what the F does that mean? So a lot of times Tom and I will go back and forth in different areas, but the cumulative knowledge you get from this, whether we're talking about volatility and deltas for one moment versus P&L graphs, will be more than you can get in any classroom out of any book. So with that all said, and that very broad framework, please try not to be frustrated if you're used to a textbook mentality. We're going to be throwing a lot of shit at the wall, and it won't all stick at once, but through repetition and different ways of saying it, you will get it all. Is that cool, Tom?
That's very cool. I'm glad you brought that up. In terms of,
we're going to go back and forth. We're going to go back and forth about Delta and you know, don't get me started. Anyway, go ahead.
Right, right. I mean, to echo your point, and the point I brought up at the outset here, they're a tool. Period. They're a means to an end. However you want to achieve it. You like Vince said. You want to make a directional bet. You want to bet higher. You want to bet lower. You can do that through options. You want to hedge a stock position, long or short. Long or short. You watch Larry a lot. Perhaps I'm getting ahead of myself, but that's okay. You watch Larry a lot. A lot of stuff I'll see in the chat. He may go home long. He may go home short SPOOs, short E-minis. Okay, he wants to be short, but he doesn't want to take the overnight risk. He'll buy some calls on top of it. Okay, now and sometimes I would imagine if he goes home long, if he went home long E-minis, something like he might buy some puts below it. Okay?
Never. I'm just kidding, but
true.
Yeah. he goes home long one E-mini, he goes home long 10 puts.
So now here, let's look at it. So now we're back at this 172 line here. Now we'll look at this. Now the stock's rallied to 73 and a quarter. We'll say for argument's sake. Now the delta's picked up. It's trading well. Now it's bounced back. It's traded out of 73 again. You got to realize. So what this is now, you got to realize. Now, why is the delta of the 70 call 70 deltas, and why is the delta to 72 54? And of course, it's that much more in the money. Okay, the probability of this stock closing above 170 on Friday, the options market saying roughly 70%. That's delta. Okay, the options market saying there's a 70% chance that this call will expire in the money, whether it's 170.01 or 196.50.
And there are multiple definitions for delta, and that's the first definition everyone should understand, that a delta of an option, and we're not talking about models and things like that, but in definition number one, the delta of an option expresses at this snapshot in time, if you're a stats person and you're looking at sine curves and tangents, it's expressing the probability that that option will expire in the money. It's got a 70% chance at that moment in time that it will expire in the money. That's the first definition of delta we all need to understand.
Yeah, absolutely. So that's important. So now here, well, we're going to stay. Vince and I are trying to stay with two terms today. If we accomplish anything in these next 20 minutes or whatever, you'll come away with these two terms, and you'll be fairly adept or fluent at it and understand how they change. Now, gamma, that's another Greek. That is rate of change of delta. Okay?
What the hell does that mean? I don't know what that means.
Neither do I. But it means rate of change of delta. Oh, you're looking at it. It even pops up on my screen. Okay. So what this means here, this stock here, it's 72 and a half at 172. I'll always leave out that. If it's a triple, if it's a 3-digit number, I always leave out the first handle. So forgive me. Yeah. With the stock trading 73, to get the gamma here is about a 7 gamma. So what does that mean? That means your delta will change, but your delta will be up or down 7 deltas for every point move in the stock. So we look here, the stock's trading 73-ish.
Wait, I'm going to interrupt you because the second definition of delta is what they need to hear so they can understand gamma a little better. Is that okay, Tom?
Go right ahead. Yeah, go ahead.
Okay. All right. All these there are 3 or more definitions of delta. This first definition is probability that the option will expire in the money. The second definition of delta, although it may seem like it's the same, it is not necessarily the same. must be known to understand what gamma is. Delta in physics and in chemistry means change. So the delta of an option, another definition of delta is it describes the correlation or the rate of change that the option has when the market moves. So if Apple moves $1, then a 70 delta option moves 70% of $1. That's a 70 delta. Now, when you look at delta from that point of view, you understand that at this moment of time, snapshot, the option's got a 70 delta, Apple rallies $1. We're not moving volatility. We're not playing any fancy games here. That option should go up by 70 cents. That's delta, rate of change, correlation with the underlying, which brings us to gamma that Tom's going to pick up. Gamma is the change in delta. So it's the rate of change of the rate of change. So if you can imagine the world in 3 pictures, and then I'll let him get into the gamma part. The option is a 70 delta. Apple moves $1 higher. The option moves 7 ticks higher. We're not changing any other things here. We're keeping it simple because we are stupid. So the option goes up by 7 ticks. But now the option's in the money by 7 ticks more. Doesn't its delta change? Yes. The delta changes at that snapshot, at that re-snapshot of that moment. The tangent on the curve goes from 70 to 71. Why? Because there's less time to expiration and the option's even more in the money. So its probability of expiring in the money goes up. The difference between 70 delta and 71 delta is gamma. And that's what Tom's going to describe more now.
Right. That's a good point, Vince. You're absolutely right. Because you got to realize now, so delta, like Vince said, probability. Yeah, before we go any further. Now you notice here, the 70s are about a 69 delta, right? We're fluid, it's 72. Now let's look at next week's. Well, 70s there are only 62. Wonder why is that? I'm going to put a response in the chat. Why do you think that is? Why is the delta for the option expiring Friday, the 170 call expiring Friday, roughly a 70 delta, while the 170 call expiring next Friday, 10 days now, 63?
If I were Tom McEntee, it would be because the market's going to go to infinity today and to zero next week, and that's why I'm going to do a calendar. I'm going to do a calendar call spread to make money off of that.
Well, that's because there's a higher with in the money options, right? Be less time to expiration,
right?
This thing 3.5 days, whatever the heck we're talking about here, versus 8.5 days. There's a higher probability we stay above 170 for the next 3 days than there is over the next 8 days. Now, conversely, let's look at the 175s. They're a 44 on December 7. They're a 37 on Friday. Why is that? For the same reason the 170 calls have a higher delta this week than they do next week.
Another way to look at the whole delta changing as you go out in time is I like to reduce things to the absurd, like make everything zero or infinity. What is the delta if an option with almost no time left to go is a 99 delta that's in the money? Then as you go further out in time, the probability, assuming that the market is random in how it moves, must decrease from that in the money option. So if we were trading options that had infinity expiration, they'd all be 50 delta.
Right.
So as time increases, in the money deltas go down, out of the money deltas go up. Is that fair?
That's more than fair. Okay. So as we go forward here, let's keep an eye on this. Here we go. Stock really hasn't done much. This delta's trading 53. Now you can test us on this. If we trade 72 today, I expect this delta to be somewhere around 46.
Right, and we're not changing. We're not changing volatility. We're keeping volatility as it is, and those are variables that are very important when you're trading these markets and affect deltas as well. But that's what Tom's saying is we're not moving any other parameters other than the market. I just want to put that in there. We're not getting fancy yet.
Right. So, and obviously, conversely, if we were to rally to 74, of roughly $1 higher than here, I would expect this delta to be 53 plus 6 plus 7 should be about a 60 delta. So I'm going to say if we trade down to 72, you can check it on your screens at some point. It'll be 46 delta. If we trade 74 in the stock, I'm looking at a 60 delta. So that's gamma is rate of change of delta. Now gamma. Now look, the gamma is 6.7 here. Maybe I'm getting ahead of myself, but that's cool. So maybe you can handle this enough.
That's what it's all. It's what it's all about. We're going to jump back and forth on that. I'm with you.
Right. So here, why is the gamma only like roughly 4 next week? The gamma's only 3 2 weeks out. Why? Because rate of change of delta. Delta will change much more dramatically the closer you are to expiration. Okay, yeah. You got to understand that, and be and really have a firm grasp on it. So the closer you are to expiration, the more the delta will change. That's why you'll see. I'm just trying to think. That's why you'll see when you see disasters occur in markets. Now they have weekly options and stuff like that. But when you see a regular way expiration in a big cap index, or we'll keep it with the SPX or something like that. When you see guys who are short a ton of like out of the money puts, that were 10% out of the money 3 months ago, and here we are 3 days from expiration, and they're they're knocking on that proverbial door. Well, now all of a sudden, my delta from being say if I just sold these 165 puts. Here's Apple. These are this week's 165 puts. Okay, delta on these things is 11. I sell 10 of these. Okay, I am long because it's -10 times -11 is I'm long 110 deltas. Now, if we trade 166 this afternoon, what do you think the delta is of those? Probably about a 45. Okay, so now I'm long 450, and it's not going the way I want. And I'm getting longer because I have, in this case, when I'm short options, I have negative gamma. Okay, I'm going to be, these things are going to pick up in price. I'm going to be negative gamma. I'm going to get longer deltas the wrong way, the way I really don't want to. So I am going to be long 450 deltas, and these things are going to be trading a lot higher. If we were to trade $4, $7 from here, I would think these things would be trading about 95. I'm sorry, they'd be trading about $1. About $1.90, $1.95. Okay, so it's
equity stuff. Don't ask me.
Yeah, so that's so what I'm saying is my rate of change of delta, and all of a sudden is now I'm short 100 of these puts. I'm short 10 of these puts. I got 100 deltas on, but now.
Wait, Tom, I'm sorry. Short puts is really complex. Can we be long a put or long a call?
Yeah, that's fine.
Just for expiration purposes.
Okay,
that blows me away when you're short puts. Am I bullish? What am I right now? Anyway, I'm just saying. I think it would be easier to digest at first.
You're right. Okay. Say I bought these puts. Say I bought these puts at 44 cents, right?
So you're bearish. Okay.
I'm bearish. Stock trade 66. My delta isn't 11 anymore. My delta is going to be about, probably around, I would say about 41, 42.
Well, aren't you going to get into the rate of change of your gamma too, Tom? I'm just kidding.
Well, I don't want to get into freaking Tao and stuff. That Natenberg book. We'll just keep it simple. We'll just keep it nice and linear. I'm going to say we're going to be about a 42, 43 delta. Now, all of a sudden, I got some muscle where I can buy the stock. That's what we got to look at. I mean, it's just going to come back to this all the time. I think Vince, I think Larry, and probably anybody I know, I'm not buying an option at 44 cents so I can sell it at 75 cents or whatever the heck it is. That's not the game. All I'm doing is if I think this is cheap relative to what else is there, if it's cheap relative on an historical basis, yes. But I'm more apt, or any professional is more apt to do something not involving a straight unwind of an options position, be it selling something lower, to wind up, lock in a spread at a decent, put a spread on at a really good price, or buying the stock. And that's where gamma comes in. Okay. You can create an equivalent stock, but say we trade down to 166. Well, now I'm short 44 deltas, we'll say. That's what we said. The delta of this thing would be 166. So I'll go out and long 10 of these. I'm long 4, I'm short 450 shares of stock. So I'll go out and buy, I'll buy 450 shares of Apple at 166. Well, now guess what?
Right. And what Tom is saying is that he had an exposure where he was bearish to stock, and that exposure was initially before the move. What, Tom? You were short what? In delta terms, you were short what? 100?
About 100. I was short 100 here, but at 166, I'm short. We'll say 500. Keep it simple.
Okay. So this is professionally called gamma hedging, or it's reestablishing delta neutral. It's taking profit. So, for example, he's bearish. He's long an option that gives him 100 delta exposure short, and the market plummets, and now the delta on the option is 45. He doesn't want to be short 100 anymore, or maybe he does. Maybe he, for this argument, let's say he wants to still be short 100. He can go in and buy 350 shares of Apple, and basically those shares he bought are hedged with the option premium, that he's locked in option premium, so to speak, and he's still short that 100. Or he can say, I think the move is done here, and instead of selling the option, I want to be able to trade if we go back up and sell stock out. He can buy all 450 shares, and now at that moment he buys the 450 shares. He's not bullish or bearish. He's flat. He's delta neutral. He has no directional exposure, but he's long gamma. And if the market goes back up, he can sell futures out. So, or stock out, I should say. So yeah.
So to keep going on the point, Vince. I buy. We'll keep it. We trade that at 65. Okay, they're a 50 delta. I buy 500. You know, I'm short 500. I buy 500 Apple at 65. Stock trades 79 tomorrow. How'd I do on my? I bought 10 of these. I bet $450, right, on these things.
Right.
But I just made 4 points on 500 shares of stock.
Right.
If I buy 165, stock trades at 69 tomorrow, or whatever the heck it might be. Now that you'd make $4 on 500 shares of stock. That's $2,000. You bet $440 over here on these puts. So you're getting roughly 4 to 1. So that's a great return on investment, and that goes back to, I think Vince was heading that way, and utility of Gama. Go ahead, Vince.
Well, that brings us to the flip side. Well, then, geez, why don't we just all buy options? Because why don't we just buy options all the time? Because when you buy an option, even if you're not playing the volatility game, which is number 3 reason to buy options, you're buying something that over time is going to lose value. If you're long gamma, and there's exceptions, but if you're long gamma, you're long options. If you're long options, you're long another Greek called theta, or decay, or erosion. And that basically means as time moves to 0, the option's value moves to 0. So if you don't get the move you need to justify owning the option in the time prescribed, you'll lose more money that you spent than you will make on the risk reward. So the cool thing about options is you get a lot of risk reward, risk 1 to make 4, and those are great, but they don't pay off. So if you're long gamma, you are also losing money every day if the market's not moving. So if the market's efficient and they're giving you options at a very cheap price, there's usually a reason for that. So if Tom buys that option and he doesn't get that move or he gets 1/3 of that move over, the life of the option, then he ends up net losing. So that's why selling options is a valid strategy. So if you're long gamma and the market's not moving, you're losing money. There you go.
Yeah, absolutely. Vin's right. Theta. That's what we covered today, and that's what we're going to cover today. Delta, gamma, theta. Okay, and Vin's right. Now look at the decay on these 72.5s. Okay, theta is theoretical amortization. Okay, don't ask me to spell it. It's going to come in. This option here, trading $2.80, right? It's roughly, what is it, about 60 cents in the money, current prices. This thing's going to come in 38 cents today. Okay, close the business now, and it's going to tomorrow's theta is going to be different because I don't want to. This might be a little bit complex, but this is roughly I want to go. Let's go out a month. I don't want to talk about this week's stuff is going to be too.
Tomorrow we come in and the market is unchanged and volatility hasn't moved. What happens to that? What happens to that option?
It's down probably 57 cents because you get it tickety tock and you only got 3 days left. So the decay is going to be more geometric or going to be geometric rather than linear. Here, I think it's better. Let's go ahead, Vin. I clicked on deck 14 out here.
Actually, while you're clicking on that, let me just throw one phrase at everyone that I think is going to let you get right to the point. Theta or decay gets geometric or exponentially greater on at-the-money options as you approach expiration. and it gets geometrically decreased on out of the money options. So, for example, if an at the money option is worth 50 cents and we don't move, that thing will hemorrhage money as time goes forward. But a 10-cent option that's way out of the money, say a 10 delta option, that will lose money at first at a similar par to the at the money, but it will decrease in its theta or rate of loss because it can't go lower than zero. Because when that 50 delta, that 50-cent option goes to zero over 3 weeks, that 10-cent option also has to go to zero. So the geometric point is this: if you're long an at the money option, you're long the most gamma, you're long the most theta, and decay, or however you call it. So I just want to throw that in there.
Right. Now look,
because we're talking about an at the money option and theta and gamma, right?
Yeah. Now look here. Look at the decay. These are the 175 calls, roughly a 50 delta option. Okay. Now it's a 50 delta option out in January. Well, we're still in Apple. This is January 18, and it's 52 days away, like the number of cards in a deck. Okay. So it's 52 days away. It's a 50 delta option. The theta is only 8 cents a day. Okay. Okay, versus what we saw for why is that? Because we're further out. We're going further out. We have 52 days. So the more time left, the more ability you have to defray your decay. Okay, so it's going to come in roughly 8 cents a day on a linear basis, and obviously that will accelerate the closer we get to expiration, given that the stock stays here at 175.
Right. So as an at the money option goes to expiration, its gamma increases while its theta increases. So if there's 1 second left in the market and the market is trading right at 175, the option has a 50 delta. It has a 50% probability of finishing in the money. And when the market ticks to 174.90, the option has a 0 delta. And when the option ticks to 175.10, it has a 100 delta. So it's got 50 lots of gamma to go with instantaneous theta going to 0 if the option finishes out of the money. Tom, you should wrap it up because I think we're over our time limit.
Yeah, done. So let's go, guys. Delta. That's equivalent stock position. All right. If we want to fashion, we'll get into how you fashion trades, but that's the story. We'll do that. Maybe we'll cover that tomorrow or the next day. Rate. This is equivalent stock position. 50. These are January options in Apple. The 175 is roughly a 50 delta. So essentially, 10 of these would give you the equivalent of a 500 share long in Apple. Okay, I'm not advocating going out and buying. I'm just using an expression right now. Now, you also got to be aware of, this is a story for another day, but you got to look at what you're paying here in terms of volatility. We're in the high rent district for Apple volatility right now.
Well, now you're talking about relative value.
That's a story for another day. This is an advocacy to buy one thing, sell another thing. I'm just telling you, it's high right now, but let's just look at it. Maybe see for example's sake, it's always in the news. 50 delta, 10 of these, 50 delta, roughly the equivalent stock position would be 500 shares of Apple. Will you get the same bang for your buck? You should. But we'll cover that in detail. Now, gamma, rate of change of delta. So here, I would watch this. We'll take a snapshot of it or look on your page. This has a 2 gamma. So that would mean that for every point in the stock, the delta would change by 2 deltas for every point. So if we went up to 174, the delta would be 52. If we went down to 172, the delta would be 48. You get that? We went up 10 points. The delta would be 70. We traded at 183. The delta would be 70. Wasn't that funny? With 52 days ago, why would that delta only be 70? It's completely different with the closer you get. Obviously, so the delta is going to be muted, or the effect on delta, the gamma is going to be less the further out you go, because the equivalent stock position isn't going to be impacted that greatly because there's so much time left. There's 52 days left, and then finally, theta is. This is your theoretical amortization. This is on a linear basis. What is this option supposed to decay on a daily basis? If you look at this is the straddle. 770, 880. What's that? $16.50. That's $16.50 out to 52 days. So roughly, that's about 32 cents, roughly on a ballpark basis. It's not going to come in 32. That'll be 16 cents on each side, and that's about what it's going to come in. 8.5 and 7 and 7.3. That's what you're expected to decay. These are all considerations: delta, gamma, theta, equivalent stock position, rate of change of delta, and amortization.
I think, Mike. I think we have to give up the screen so Mike's got something else to do. If you have any questions on this And if you feel like you don't understand some of it, don't worry. It's going to keep coming back all the time. There is a post for beginners showing P&L graphs. We'll discuss those as well. Those are the first three Greeks we're going to talk about, and we'll go over them again and again and again.
That was fantastic information, and I want you guys to just pace yourself. You guys are going to be going 3 days a week. You can't be giving up all the information on day one in the first half hour.
Tom's going 3 days a week. I'm going to be asking questions from the chat room. I'm going to be seeding the chat by saying, Tom, why do you sell options? That's so un-American.
Guys, we're noon tomorrow and Thursday, correcto?
That works. Yes, that's what I have scheduled. A lot of great information. Our first Tom and Vince webinar, really great educational information. Thank you very much. And we'll speak to you guys, like Tom said before, Wednesday and Thursday. And, have your questions ready. Thanks a lot.
Sunil, I'm disappointed. There were no questions about Monte Carlo or partial differential equations. I'm very upset about that.
Hey, great being with you guys. Great speaking to you, Vince. Mike, as always. We'll talk again tomorrow.
All right.
I don't care what they